This episode is brought to you by Mortgage Workflow Partners and the Mastering Encompass series, both for users as well as administrators. You can find out all the information about it over at masterengencompass.com. Also, if you'd like to check out what we're doing on YouTube, go ahead and subscribe to the channel using the @MasteringEncompass handle. And make sure you stay up to date on all the information, not just with podcasts, but also video content that we bring to you as often as possible. Now let's get on to the episode. Hey everybody, Larry Bailey here, bringing you another weekly update for the news that happened in the markets last week. Today is August 5th, 2024. We're going to go through the week of July 29th, 2024 in review. There was a lot that happened. And it's moving the markets. I don't know if you can see that number right there, but that says 102.02. Not too long ago, that was actually below 100, and that means mortgage rates are going to be getting better very soon and very quick. And it's important for you to understand why, which is what we're going to go through today. Listen, it's important to understand that the Fed held rates steady, but hinted that it's time for a rate cut, and it might be approaching very quickly. Plus, there were some more signs that the labor sector is weakening while home prices hit a new high. Here's the stories we're going to go through in this episode. First story is Fed holds rates steady, hints at a September cut. I'm going to tell you right now, the odds of a September cut just went through the roof from Friday's job numbers, but we'll see. You never know. The next story is weak July jobs report, more indicative of real picture. We'll talk about that, what that means. The next story is private payrolls hit the lowest level since January. That story is followed with the story of the JOLTS. That's the jobless claims show labor sector weakness. That's the job report that we're going to talk about. Next story is home prices hit a new record high. That's everybody's problem if you're trying to afford something. Then the last story we'll talk about here is pending home sales jump higher in June. And you're probably, I don't know if you're in the market for buying a house, if you tried to get into an open house this weekend, you were probably met with the same kind of patterns that I saw here in New Jersey. Applications are through the roof compared to even a few weeks ago, and inventory is probably going to get snatched up if the house looks cute or that kind of a thing. Wait and see. So the first story here is the Fed holds rates steady and hints at September cut. After 11 rate hikes since March 2022, the Fed once again left the benchmark Fed funds rate unchanged from a range of 5.25 to 5.5. This decision was unanimous and marks the 8th straight meeting the Fed held those rates steady. Remember that the Fed is the interest rate for the overnight borrowing between banks and the Federal Reserve, and it's not the same as mortgage rates. But like I said earlier, we saw some really big movements that are going to affect mortgage interest rates. And as a reminder, the Fed's been aggressively hiking that Fed funds rate to try and tame inflation and try to slow the economy from runaway inflation, those kinds of things, because obviously that's been rampant the last few years. So the bottom line here is cooling consumer inflation combined with signs that the economy and job markets have been slowing are leading to continued and growing calls to the Fed to begin cutting its benchmark Fed funds rate. Jerome Powell did comment to a rate cut at their meeting on September 17th and 18th, saying that the Fed thinks the time is, quote, approaching, and if we do get the data that we hope for, then a reduction in our policy rate could be on the table at the September meeting, close quote. And so when this came out last week, remember, it was in the middle of the week. And so this was kind of leading up to some more information we're going to go through next. So definitely read on here and listen on. So the next story is the weak July jobs report, more indicative of real picture. And this was the huge market mover on Friday. If you didn't know that this happened, I understand because you're probably not, paying attention to all this stuff. But it was an enormous change in connection with, it's not even in these stories, but in connection with the global stock sell-off, which has to do with all of the news coming out from the semiconductor and the chip makers and all this stuff. All this kind of happened in a perfect storm, and you saw money leaving stocks and going into treasuries and mortgage-backed securities in connection with these stories. It was just right time, right place for mortgage interest rates. So here we go. Here's the next story with the weak July jobs, more indicative. So the Bureau of Labor Statistics, that's the BLS, that reported that there were 114,000 jobs created in July, which was well below the estimates of 175,000. And then on top of that, there were negative revisions to May and June, which removed 29,000 jobs that were on those reports combined. So the unemployment rate obviously rose, and it rose from 4.1% to 4.3%, which is the highest level since October 2021. So the idea here is when we go through these kinds of movements, what we're really talking about is that there were signs of labor sector weakness was all throughout this report. And not only was the headline job number, which again comes from the report's business survey, well below estimates, the report's household survey, that showed even lower number of job gains. That's where, remember, they literally call houses, right? They call them like, hey, do you have a job? And people say yes or no. And so that was just at 67,000. So this latter figure, that 67,000, that's considered more real time. And it's because it's derived by, like I said, calling households. So the business survey is more like modeling and estimations. In addition, the number of people employed in part-time for economic reasons rose by 346,000 to 4.6 million in July. Those are part-timers. These are people who would have preferred full-time employment but were working part-time because their hours had been reduced or they were unable to find full-time positions. The number of people who could only find part-time work, 51,000. So regarding wages, hourly earnings, they were also below estimates while an average weekly earnings declined. So a lot of stuff on here. Remember, the Fed's got a dual mandate, right? And maximum employment and stable monetary policy, two big mandates. And so as they were trying to work on the monetary policy beginning stable with inflation, things like that, they also have to keep an eye on maximum employment. And these kinds of numbers in these reports, all of a sudden now you got to pivot. And one of the ways you pivot, of course, is to reduce interest rates. Hence, the more certainty of a September cut. We'll see. We'll see. We got a long time before now and then, believe me. So the next story is private payrolls hit lowest levels since January, and this is from ADP. So job creation among private employers slowed for the fourth straight month per ADP's employment report, which showed employers added 122,000 new jobs in July versus the 150,000 that had been forecasted. Large gains in trade and transportation, construction, and leisure hospitality were offset by losses in the information and professional business sectors. And we've talked about this in previous weeks where it's like, when are we going to start seeing? Now, again, I think it was Intel just announced they're cutting down. I probably had that name wrong, but somebody just announced this weekend that they're laying off 10% of their workforce. They have to cut like $10 billion of their budget, like just complete 180 in their business. And we're probably going to see a lot of that come out in future job numbers. So the bottom line of this story is job growth is clearly slowing while annual pay gains have also decelerated for both job stayers, and that was 4.8% from 4.9%, so it dropped 0.1%, and job changers went down to 7.2% from 7.7%, so they lost 0.5% of pay raise by changing. The Fed is watching this closely as it can help alleviate wage pressured inflation. Neil Richardson, that's a chief economist of ADP, noted that, quote, with wage growth abating, the labor market is playing along with the Federal Reserve's effort to slow inflation. If inflation goes back up, it won't be because of labor, close quote. So the JOLTS, next story is JOLTS, jobless claims show labor sector weakness. Now, this is the latest job openings and labor turnover survey, that's JOLTS. That's the report. It showed that job openings fell slightly to 8.184 million people in June, well below the high of 12 million hit we saw back in 2022. The hiring rate, that fell to 3.4%, which is the lowest level in 10 years, not including COVID, of course, while the quit rate remained low, 2.1%. A low quit rate suggests there is less poaching from other companies and fewer people feeling confident about finding new employment. In addition, the latest week's report showed that the number of unemployment claims that were filed rose to the highest level of the year. First-time filers, as measured by the initial claims, totaled 249,000, while 1.877 million people are continuing to receive benefits after filing their initial claim. Bottom line of the story, gang, is we will continue to see more weakness in the labor market with less hiring. fewer people quitting their jobs, and rising unemployment claims. That's just math, right? It's just the way it works. The Fed, of course, will closely be watching all of this in the upcoming labor sector reports as they weigh monetary policy and the timing for rate cuts this year, given their dual mandate, as I said a moment ago, price stability and maximum employment. Next story. Home prices hit new record highs, and I think we've hit new records pretty much every month. I don't know if it's every week, but certainly every month. We just keep going up and up and up and up. And you can see that here on the chart, which reminds me, if you're listening to this on podcast, thank you very much. But make sure you head over either to our YouTube channel. You can find us there at Mastering Encompass, or you can get over to Mortgage.community. If you want to see all this information on video replay, go ahead and check it out in those two places. So the Case-Shiller Home Price Index, which is considered the gold standard for appreciation, showed that home prices nationwide rose 0.3% from April to May after a seasonal adjustment, breaking the previous month's all-time high. Home values of May were also 5.9%, higher than a year earlier, following a 6.4% gain in April. The Federal Housing Finance Agency, that's also known as the FHFA, in case you ever hear that, that house price index also reported that home prices were unchanged from April to May, with prices 5.7% higher than the previous year. It's a good reminder here, the FHFA does not include cash buyers because they're not borrowing money. It does also include loans over the conforming limit, and because, and that kind of drives why you'll see a difference between the Case-Shiller Price Index and the FHFA. Bottom line of the story, gang, is national home values, they're going up. They're going up, 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 and they're always hitting new time highs, apparently. It's still, obviously, because of all that, housing is still a solid investment, generally speaking. Of course, every situation can be different. Different parts of the country have different things going on. So buyer beware always. But it is important that the S&P DJI's head of commodities, Brian D. Luke, confirmed, quote, "The waiting game for the possibility of favorable changes in lending rates continues to be costly for potential buyers as home prices march forward," close quote. Luke added that Case-Shiller's home price index, quote, has appreciated 4.1% year to date, the fastest start in 2 years. So I'm going to put this in real numbers. Your $200,000 house-ish just rose 10 grand. So if you had bought that house in January for $200,000, and let's say you paid 7.5% interest rate, if you can now get a 5-point-something% interest rate, which is real as of right now, you would have absolutely made out better. You'd be in your house, of course, already. A, B, you would have paid less. And then everything else is from there, right? So, and that's just 4.1%. There's other markets that are growing way faster than that, if you could even find the house that you want. So I'm always going to tell people, if you're looking for a house and you find a house that you want, get the house you want. Worry about the money second. Now, there's a distinction here between affordability and insanity. So even if somebody tells you you can qualify, you can get the house, you got to afford it. You got to afford it. And so I'm launching out a new project. It's called Credit Plan HQ. More information to come on that. And we're focusing in on helping people understand credit, helping people understand the path to home ownership and the way to keep your home and the way to manage budgets and the way to really help everybody who's truthfully never been taught about credit and understanding how to actually use credit to your advantage. That's what we're doing at Credit Plan HQ. More to come on that, and that's a personal project of mine that I'm doing because I want to help. I want to go back to helping the borrowing public. I've been helping businesses grow their companies for the last 12 plus years. That was after I spent the first 20 years helping the general public directly. And I'm going back to that. While I continue to help businesses, I'm going to go back to helping the general public in meaningful ways. More to come. So let's get on to the next story. The pending home sales jumped higher in June, and we've got here pending home sales rose 4.8% from May to June per the National Association of Realtors. That's the NAR, coming in well above estimates of 1% rise. So they were expecting 1%, and they got 4.8. I wonder why. Sales were 2.6% lower than they were a year earlier, though this is an improvement from May's negative 6.6% year-over-year comparison. So the report measures signed contracts on existing homes, making it an important forward-looking indicator for closings on these homes measured in the existing home sales report. Bottom line here is the pending home sales index reversed course after declining in April, like we talked about. in May. And the NAR's chief economist, Lawrence Yun, explained, quote, "The rise in housing inventory is beginning to lead more contract signings. Multiple offers are less intense, and buyers are more favorable position," close quote. I don't know about that, Lawrence. I mean, you're the chief economist, so you know way more than me and probably way smarter than me. But we're going to see. You know, I think rising inventory is an interesting way to put it. So we'll leave it at that. If you're interested in the Family Hack of the Week, this is National Peach Month. In case you didn't know, it's August, so it's National Peach Month. There's an easy, delicious recipe of peach crisp from All Recipes. You want to check that out sometime around the 15-minute mark here in the recording on the video. Check it out. Last week was super busy, not so much this week. The only thing we're looking for this week is the latest jobless claims on Thursday. I got an idea that everybody's going to be watching the stock market way more than the bond market. Again, this price of money at 102, the U.S. 10-year Treasury's down to 3.6. This was like at 4.2%. I don't know, it feels like yesterday, but it wasn't too long ago. But there it is. This information, of course, is brought to you from MBS Highway. You can always find it at mbshighway.com. My name's Larry Bailey. Thanks for listening. We'll catch you on the next one. Take care.